Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, June 3rd, 2024. Hope everyone had a wonderful weekend. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are a busy week for key macro themes and elections in India, Mexico, and South Africa. In terms of market implications, this is a busy week of critical economic updates, headlined by the ISM PMIs, monetary policy decisions by the ECB and the BOC, Bank of Canada, and the JOLTS report and jobs report in the U.S. The data will go a long way towards evolving the fundamental outlook, perhaps in ways that break the current stasis between our bullish and bearish themes. Recent general elections in Mexico and South Africa were not as well received as election results in India, which are likely to contribute to Indian asset outperformance over the medium term. We're not yet at a point in the market cycle where it pays to bet on DM asset outperformance relative to EM assets, but we are at a point in the positioning and business cycles where investors should migrate up the quality spectrum with respect to any EM exposure they have. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one reads, Global Liquidity Monitor. It says, hey, Darius, I love the Global Liquidity Monitor section in this week's Around the Horn presentation. To confirm, the previous GDP/CPI column was looking back at the last quarter, whereas they're now looking at the next 1 to 2 year consensus growth and inflation estimates. That is correct. So we replaced the actual real GDP column with real GDP expectations. Then we added the headline CPI expectations as well as the consensus nominal GDP expectations, and those are blended 1 to 2 year forward rates. Those tend to have the best correlation to asset market performance. And so getting back into the question, says second, I wanted to see if I correctly understand why each of these component relationships you noted is bullish for a currency. Currency is bullish when nominal GDP growth expectations are rising from a high base with a policy rate that is flat to up. Number one, rising growth expectations means countries that want to buy countries want to buy the currencies. Means other countries want to buy the currency to buy the country's goods and stocks. Number two, policy rate flat up means investors can expect to earn interest holding the currency. And three, high GDP base means little need for government to stimulate with loosening financial conditions and or money printing. So that is correct. So yeah, just confirming all that. So the investors, the person who wrote the question, their assumptions are generally correct. Rising GDP growth means that investors are either chasing this from a capital or current account perspective, i.e. through the trade channel or through the portfolio investment channel. Number two, policy rate flat to up means that investor expectations for the policy rate, which tend to have from an interest rate differential standpoint, tend to be highly correlated to the performance of currencies. Those are moving either in a neutral or positive direction with respect to the currency. And obviously the reason for that being, investors want a yield when they're allocating assets. They want an ex-ante return. And so with respect to the currency market, it's typically short rates in that country's local sovereign debt market, or if it's a developed market investment grade market, those things tend to be heavily correlated from a rate spread perspective. And then lastly, a high GDP base means little need for the government to stimulate with loosening financial conditions or money printing. Bingo. Don't really have anything to add there. That's exactly why we have that logic there. So definitely check that out. If you've missed that, that's something that we're going to be refreshing again 6 times a week for our clients here at 42 Macro, so that they can stay on the right side of a geographic dispersion within and across asset markets. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, June 3rd, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.